Welcome to the Craig Brock Real Estate Show, helping you navigate through all the challenges and pitfalls related to real estate. Craig is San Diego's real estate investment strategist. And now, here's Craig Brock.
Good morning, Southern California. Craig Brock here. More news recently, just out of Fannie Mae, Freddie Mac. More talk about dismantling these entities, where about 75% of all mortgages end up. That's right. The private sector is expected to take over eventually, but we don't want that to happen too fast. No way. Here we're about 5 years since the epicenter of the credit crisis, and we have more news concerning the big banks. Credit Suisse is in the news today. There's a scenario where they've pled guilty, and they're going to pay a fine of more than $2.5 billion for helping Americans evade taxes. Certainly not good by any means. More news here in the Southland from Jeffrey Gundlach, the famous bond manager, basically stating that residential housing is in trouble. It's not heading for a repeat of the 2008 collapse, but it's equally unlikely that housing growth will provide the needed push for the U.S. Economic recovery. Well, those words certainly resonate with caution. And had a client in my office just the other evening that was turned down from a mortgage, or for the mortgage that she wanted with Bank of America. She went out to a mortgage broker. Same thing happened there at San Diego Funding, unfortunately. She really was upset. She was in tears by the time she got to me. She's looking for a better way. There is a better way to get into a home. If you've had credit challenges, if you've had past foreclosure or short sale or bankruptcy, you're probably looking for a better way too. It doesn't seem like the banks want to help you by any means, but we have experts here on this Bloomberg network that can help you. And that's why we want to reach out to Terry Lewis with Seller Finance Consultants. You just heard the message at the top of this broadcast. Seller financing is the old strategy to get into a home, but it's also the new strategy. It's something that we're indeed going to hear more about in the future. Good morning, Terry. Thanks for joining us here on Financial News and Talk.
Good morning, Craig. How are you this morning?
I'm doing well. It's, a lot of the listeners and a lot of the people that contact various bankers' offices are not doing so well. They want to get into a home. They just, they went through tax filing earlier this year. They don't have a deduction on their Schedule A for mortgage interest, maybe because they were forced to short sell their home, or worse yet, cash for keys, lose their home to foreclosure or do a deed in lieu. But they want to get back into home ownership. They're told by their accountant, their CPA, that this is the only deduction that they really have, the only viable deduction. And they're looking for answers, and they're looking to you in particular, or they should be looking to your office, because you do have many of the answers, and you have experts on your team that really can go the extra mile, that can make the difference to make this a productive scenario to get back into a home.
Yes. So, the American dream is alive and well, and that's a mantra that we have. We are talking to so many potential buyers that just because of the lending requirements can't obtain a loan. However, they have down payment, they have income, they have credit. They're in pretty good shape financially. It's just that the banks have restricted their loan requirements for them to get loans, and so the alternative is to have seller financing. And I'm really pleased this morning to have with us on the radio what I consider a mentor of mine, attorney Jim Eckley, who I've been corresponding with for the last 3 years on this subject. And he's really a key person that understands seller financing for the last 30 years. And I'd like to introduce him to the audience today. And
absolutely.
Have him say a few things about where he thinks the real estate market is going. Jim, are you with us?
I certainly am. Thank you, Terry, for that introduction. I'll send you the usual six-pack to go for that.
Okay.
Well, now, yes, I can chime in on that a little bit, and I think Craig did a very good job in introducing the issue, and that is we have a marketplace right now that seems to be in melees, and if anything, the most recent news suggests that the housing market may even decline a little bit more. But I don't think it's, as Terry says, and I agree with him, I don't think it's for a lack of consumer desire to enter that marketplace. It's by a lack of means. Now, most of that means has been generated by a new credit paradigm that the Consumer Financial Protection Bureau brought about called the qualifying mortgage. It was a belated attempt to catch the pigs after the gate was left open, and that was that last marketplace that inflated into a bubble, exploded, and then Congress sat down and decided they were going to curtail that permanently by generating new mortgage qualification standards that are the highest that we've probably seen in probably 30 to 40 years. And most of those now are disqualifying a good bunch of buyers from that marketplace, not just now, but perhaps permanently if they stayed. Now, Congress, one by one, is trying to dismantle some of the bigger teeth in that new mortgage rule, but it's not doing it fast enough. And when there isn't enough money to support the market, obviously the market sinks. We have some statistics that are pretty alarming and suggest that the entire direction that we're going today, which is talking about a seller-carried finance, a private finance essentially between buyers and sellers where they really carry contract, may be viable. And here's a good one. There was a 64% home ownership in 2006, it looks like. Today there's 57. Now what that means is 15 million people are out of homes right now. Now that doesn't mean 15 million people don't want to be in them. It means 15 million people lost their homes that had them before. I don't think it's a paradigm change. I don't think it's that everybody has decided to rent. It's that economics of the last 10 years has forced them to be a tenant when they want to be home owners. And that right now, unfortunately, when they go to access the money to do that conventionally, it just plain isn't there because they can't qualify with the new underwriting standards. So from that standpoint, they really are closed out probably for a long time. All those people that did have those defaults, that did find themselves not able to stay in that last market and perhaps did a modification or in most cases a short sale, now have what I'd call a stink jacket from a financial standpoint on them that's going to last between 5 and 7 years depending upon the kind of loan that they short sailed on. So they are out of that market. That alone is enough to disqualify them. So now we have that group, and they're not poor. These were people in some cases that did a strategic default. They essentially gave their property back in non-deficiency states like California, and where the only real liability of the borrower on a first position purchase money mortgage is the land itself, but not the money as well. It was a strategic default to get out from underneath a home that was so severely underwater that they were never going to dig out. It was actually a smart move, but it didn't mean they were broke. They went away typically with two incomes. They have money in the bank. There's a lot of very good, viable buyers out there with lots of money down. And so this is a marketplace that's revived itself. About 4 years ago, Sandicor reported that it was a half a point in the marketplace. Now it's about 5%, which it means it's vying with VA as a market presence, as a mechanism now for purposes of finance. So its day has arrived, and it's not the first time. In the late 80s it arrived, and in those days it was another real estate hardship. There was declining times. There was terrible interest rates, and in those days if a person went to the bank to borrow, they could expect 16 to 19% interest rates on their mortgage, which essentially killed that marketplace. And the only thing left was once again consumer finance to bypass the conventional marketplace and generate private finance. And it was usually something like a 3 or a 5 year carry. And then ultimately the buyer would go out. They now have a new credit history that's a good one, and they would go out and seek a replacement mortgage money after the interest rates came down, and the matter worked out rather well for virtually everybody. So I agree with both of you. I think that's the direction it's going, and we're going to see a lot more of it.
Well, bypassing the big bank seems to make a lot of sense. 5 years since the credit crisis, 5 years since the eye of the storm, and we're still seeing big banks in the news that are not doing anything to help the consumer, unfortunately. We're a quarter past the hour here on Financial News and Talk on the Bloomberg Network here in the Southland. We have Jim Eckley on with us this morning live. He's an attorney. He's really a placement specialist. He helps get the job done with Terry Lewis at Seller Finance Consultants If you're considering getting back into home ownership and you've had credit challenges, maybe severe credit challenges, some severe derogatory credit, and let's face it, if you have challenged a credit card, if you've challenged anything on your credit report, you probably have problems that you don't even know about. We are in the process of preparing, of restoring hundreds of listeners' credit at this very moment. You'd be surprised what a challenge on your credit report can do. It can really adverse affect you. If you want to know more about how we can restore your credit, you can go to craigbrockmortgage.com, or you can call my office anytime at 855-900-EASY. And I want to get back to Terry Lewis at Seller Finance Consultants. Terry, I do want to get your website out as well for listeners that have been hearing you on this Bloomberg broadcast that want to know how they can get back into a home. You make it so easy. You have this terrific website that's set up. It's sellerfinanceconsultants.com. But I really want to get to the rubber on the road, so to speak, when it comes to putting together these strategies, because there is a lot to be concerned with. Listeners want to know where their money's going when they're getting into a new home, and the sellers that are considering utilizing this strategy, let's face it, if you owe more on your property than it's worth, and you're thinking, I need to unload that property, I'm tired of tenants, toilets, and trash, you have a solution for them. And I know it's a lot of information for this broadcast, but basically the nuts and bolts are you have an attorney that's set up to draft all of the documents. Everything's done in 100% compliance, correct?
That's correct, Craig. So the Dodd-Frank Act in most cases requires a disclosure process that's typical to a loan application, and we're available and licensed to do that in California. And with Jim Eckley's help, we've we've acquired the documents that are required to do that and have a fully compliant transaction. And then also, I'd like to bring Jim back in because we talked about buyers, but I really feel that the big aha moment is with sellers. And Jim, what are some of the advantages that a seller would have to selling to an owner, seller financing occupant?
Well, Terry, thanks for asking that, because I really believe there's reasons to be involved as a buyer or seller in private financing for many beyond just having maybe periodic credit trouble that you want to repair potentially as a buyer. For instance, we understand the concept of leverage, which means that those things you can buy on time sometimes are a little bit better use of money than paying all cash. And so for a buyer, even one that was capable perhaps of getting a conventional mortgage, sometimes the installment treatment of fashioning payments to fit a budget and fit a investment plan is a good idea, and the only place you can do that is through personal finance, where you have the ability to design the terms, whereas when you go to the bank, it's size 7, and if your foot doesn't fit that shoe, that's too bad, you're out of the loop. But going to a seller's end, what seller in their right mind wouldn't want to do this for purposes of two things? First of all, when they're carrying a contract, they can get market interest on that contract that's well beyond what they would get in a bank or in their money market, which is typically paying a half a point, 6 to 8% on that contract, and hard money, meaning money that is that which folks are willing to pay a little bit more for various reasons, can get 10 and 12%. So it's a darn good return on an asset. And in many cases, even if it's a wrap, meaning that you still owe the underlying mortgage, and you've sold a wraparound contract to the new person who pays through to satisfy the underlying and also give the seller the balance of the money over a period of time, many times the underlying encumbrance is 3.5%, the contract is 7%, so there's a huge arbitrage potential to make money on top of money without actually having any further investment in it. So even properties that may appear to have zero equity on a value basis, once the debt is taken away, over a 5 or 6 year period can actually have perhaps $50,000 to $100,000 of income equity in it, in the spread between the underlying rate of the loan and the one at which the contract was sold at. The next part is taxes. So lots of people actually own property free and clear as a seller. And let's take say an elderly lady whose husband has passed, the children are gone, she's an empty nester, she has a large home, and maybe it's $1 million home. Now, would it be wise for her to sell it in one lump sum of cash in a given year, or would it be wiser for her to take it on an installment basis? Well, here would be the answer to that. With California taxes, income taxes I'm referring to, and federal income taxes, she would get a $250,000 deduction against the profit. She typically bought the property years ago, maybe for $300,000, so she's got a $700,000 potential gain. She's going to get $250,000 knocked off of that, and the balance is going to be taxed both under California income taxes and the federal income taxes, and the taxes on that would be somewhere in the neighborhood of about $96,000 if she took all of her money in 1 year. Yet if she took it on an installment sale agreement over 5 years with equal payments, her taxes would be $71,000. So the savings would be $20,000 to $30,000, and in the meantime, she'd be getting interest on it that is well beyond market rates of interest anywhere else, and certainly beat her savings account. And she holds the title until that property's paid off, so she still has the asset too. Now that's a deal, and from the standpoint then of my perspective on this, it's not just for moments of hardship, although it works there as well. It's also even for moments of considerable gain. That this makes really good sense, even just from a tax standpoint, if not a rate of return standpoint. So I'm for it either way.
Mr. Eckley, I'd like to ask you a question. I'd like to have you break down this RAP scenario. The AITD is, I think, an acronym that also describes it. Many of our listeners that are engineers, and let's face it, we're in close proximity to Qualcomm. Many of them are engineers, but I'm thinking of an engineer in particular over at Hewlett-Packard that has a unique problem. They have a property out in Rancho Santa Fe where they owe significantly more on the property than it's worth. Many of those homes that are out in the Santa Luz area, had these really high values, and then they've fallen back, and sure, now they're gaining value again, but they're still underwater. The appraised value is significantly below what the existing mortgage is. You mentioned the term RAP. Can you just explain briefly how this might help someone get out of this underwater property?
I think I can, and I'm going to take something you said as a given, because in my years at this business, it certainly has proven itself to be true. And that is that real estate's just like the tide. It comes in and it goes out, but it comes back in again. And so there's an ebb and a flow in real estate that we have to just realize that, as in all things, sometimes it's a bad time to buy, sometimes it's a good time to buy. Now, particularly properties in Rancho Santa Fe, they've suffered a lot, and for those that bought at the top of the market, the feeling almost is by how much they've dropped that they would never reach that price again. Actually, I've lived a little short of 70 years now, and I'm going to have to tell you that my experience is that is totally untrue, and those markets do return if you're given enough time. But let's say you're in a position you need to sell today. We do know this. All the better economists in our region are telling us that one magnificent additional quality to seller carry finance is that you can get a better price, because terms dictate price. And when the terms in the past have been all cash, go find yourself a mortgage, and jump through all those hurdles, including large down payments that some of the mortgages are now looking for, 20 and 30% down, that's a pretty significant term that really does reduce price for those that can afford to do that. But let's just say we can be a lot more liberal. We can take 5 or 10% down. We can take a person who has a very good financial and would like to get into these properties. They will tend to pay a greater price, and the current statistic is somewhere in the neighborhood of 15% more. So even assuming, let's say we had a property that was valued exactly at what the underlying mortgage was by today's appraisal and rates on a conventional appraisal, well, you'd have a 15% equity in that property automatically under a sale agreement. Now, that's just the average. Some of them are higher, some are lower. But it means then that you have the capacity to create an equity by terms and the very documents you're using that you wouldn't otherwise have. Now, the term that you used, Craig, was the AITD, which means the All-Inclusive Deed of Trust. And all that really means is it's an additional instrument by which the current owner sells to a private buyer. It's privately held by the seller. And that instrument is for the purchase price after the down payment. And that price is usually even to or in excess of the underlying encumbrance. But there doesn't have to be. You can even have one where the underlying encumbrance is larger than the current balance. I don't suggest those, but sometimes people will do that, assuming that the property is going to appreciate anyway, and at the end of the contract when they replace it with other finance, it'll be that price. So what it
so
means is that they pay through to the underlying, and they don't pay off the underlying. It's usually done through a servicing end of one of the title companies. It's all automatic. The accounting is done every year, and each party gets the accounting, so they're reporting the right numbers to the tax authorities. It's a heck of a good deal, and it's something that we're going to see a lot more, and we certainly saw a lot of in California in the 80s, and we're seeing a lot of now, and there's going to be more.
So Jim, you with the experience of 30, 40 years of doing this, have the experience and the forms and the legal means to do this, obviously. So can you give the audience your contact information, so if someone's in this position, they can contact you directly?
Well, sure, and it also might be a site that I'm going to give here in a moment that would be helpful for additional information, something that we won't have time for on today's show. But if they would go to www.eckleylaw, that's all one word, ECKLEYLAW.com, they'll find not only our various locations and me and the rest of our crew, but they will also find a section called Articles. And in Articles, if they double-click, there's a theses, or at least instructions, on many, many things in real estate, but particularly describes what Craig just asked me about wraparound contracts and their legality and how one handles them and accounts for them. So they'll find it all there. And if they need to talk to me, they can double-click past that, and they'll reach me.
Awesome.
Fantastic. Well, Jim, really appreciate your contribution.
Well, it's been fun to be invited here today, and it's a great show. I always like listening to it, and Terry's group over there, I want to tell you, is the best in the state, and they really are way ahead of everybody else, and let me tell you the one reason why. In addition to understanding these economics and being the first on the scene, they also have documents that are CFPB compliant, which almost no one else does. The CFPB went hard on January 10th of this year, and everything in the entire real estate industry and consumer finance had to radically change. And the only ones I've seen so far that have the right instrumentation to go forward, because they were planning on it for the last couple of years, is Terry's group.
Well, thanks for that endorsement. That's awesome. Thank you, Jim.
That is fantastic. We'll really appreciate your sage advice, Mr. Eckley. And Terry, appreciate you hooking us up with Jim Eckley as well. Doing things right. There's a lot to know. Terry, I know you want to get your website out there again for listeners, please.
Yeah, that would be sellerfinanceconsultants.com, and our phone number is 619-786-5550. And thanks for having us again.
You bet. Showing you the way to home ownership, Southern California. If you've been turned down by the big bank for a mortgage, if you thought that there was no other way to get into a home of your dreams, or any kind of a property for that matter, maybe it's just an investment property, Terry Lewis has a strategy for you. I'm Craig Brock with Rancho Financial, mortgage banker. But let's face it, sometimes the banks say no. That's when you want to know Seller Finance Consultants. SellerFinanceConsultants.com. Have a fantastic day.